Hey, welcome to our explainer. Today, we are diving into one of the biggest stories in global finance, the absolute explosion of digital payments. We're going to explore how it's completely reshaping economies, but also uncover some of the serious risks that come with moving this fast. Let's get right into it.
Okay, let's kick things off with a number to really help you grasp the sheer scale we're talking about. $3.2 million. That's how much money is processed by mobile money platforms around the world every single minute. It's just a staggering figure, and it shows you how central this tech has become to daily life for billions of people.
So, how in the world did we get here? Well, this first part is all about the speed, the velocity of this change. Digital money has gone from being, a luxury product to an absolutely essential lifeline for entire economies. And it happened way faster than almost anyone predicted.
Now, this number, wow. This represents a monumental shift. A full 75% of adults in low and middle income countries now have some kind of financial account. We're talking about a massive leap in financial inclusion, creating economic opportunities that just plain didn't exist a decade ago.
And a huge driver of that change has been mobile money. The industry recently blew past an incredible milestone, 2 billion registered accounts globally. To put that into perspective, that's a financial platform with more users than some of the world's biggest social networks. It's massive.
And if you want to understand just how fast this whole thing is accelerating, look at this. It took nearly 2 decades to get the first billion users on board. The second billion? Just 5 years. This isn't just growth. It's a classic hockey stick curve that has fundamentally rewired the global financial system.
All right, so let's move on and see how this all builds on itself. Because, the story is no longer just about sending money from one person to another. We're now in a phase where this technology is becoming the actual foundation for a whole new digital economy.
Okay, so there's a crucial concept you have to understand here. It's called digital public infrastructure, or DPI. Now, the easiest way to think about it is like this. It's like building digital roads and bridges for money. Instead of every bank having its own walled-off, closed system, DPI creates these open highways that allow all kinds of financial services to connect and talk to each other seamlessly.
And this isn't just a theory. We're seeing it in action all over the world. India's UPI and Brazil's Pix are these incredible systems that allow for instant payments between any bank or any app. At the same time, governments are using this kind of infrastructure to digitize things like welfare and pension payments, which is often the very first time someone in a previously unbanked community ever interacts with the formal financial system.
And we know it's working. This number, 81%, that's the percentage of account owners in low and middle income countries who actually made or received a digital payment in the last year. That shows this isn't just about having an account sitting there, it's about active, meaningful use, all driven by this new infrastructure.
Now, this brings us to the next layer of innovation, and this is where things get really exciting. Once you have everyone transacting digitally, you create this trail of data. And that data is now being used to unlock all sorts of sophisticated financial products for people who were, frankly, invisible to the old system.
Just look at this incredible surge. In sub-Saharan Africa, fintech lending went from just 13% of all fintech funding in 2020 to a staggering 88% in 2023. This is absolutely explosive. It means that small business owners, entrepreneurs who never had a traditional credit history, can now get loans based on their mobile money activity.
And it's not just about credit either. We're seeing the rise of what's called embedded microinsurance, things like health insurance or crop insurance for farmers. Products that were once impossible to distribute are now being offered directly through mobile apps, creating a safety net for millions of vulnerable families.
Digitalization is also completely transforming remittances. That's the money people send home across borders. Digital channels have grown from just 13% of the total flow to 46% in only 5 years. And why does this matter? Well, it's making it cheaper and faster for people to support their families, which is a huge goal for global development.
So up to this point, the story sounds pretty incredible, right? Global access, economic growth, what's not to love? But this is where our explainer has to pivot. Because with this incredible speed and scale comes enormous risk. The promise is now being challenged by a whole new set of perils: fraud, debt, and growing inequality. Let's start with what is probably the single fastest growing threat in this entire ecosystem. Experts are literally calling it a fraud epidemic. The very systems that were designed to include people are also making them incredibly vulnerable. Think about this for a second. Globally, nearly 1 in 5 adults with a phone encountered some kind of financial scam last year. That means it's very likely someone you know, or hey, maybe even you, was targeted. This is not a niche problem. It's a mainstream crisis that's eroding trust in the whole system.
And here's the really tough part. The problem is most severe in the very places where digital finance has grown the fastest. In sub-Saharan Africa, that number jumps to nearly 30%. New users, who might have lower digital literacy, are unfortunately prime targets for these increasingly sophisticated scams.
So all of this forces us to ask a really tough question. Are we even measuring the right thing? For years, the goal was simple: get everyone an account. But now we're realizing that the real measure of success has to be far more nuanced than that. Take this, for example. Women's loan balances are, on average, only 46% of men's. This just goes to show that even when people have access to these same digital tools, deep structural barriers are still there, preventing true economic equality. In this quote, it's from a leading financial inclusion strategy paper. It really gets to the heart of the issue. It forces us to ask, what good is a bank account if it's just a gateway to predatory loans and unsustainable debt? The industry is finally waking up to the fact that access by itself is not success.
Which leaves us with this central question for the next decade of development. Is simply having an account really enough? And the answer increasingly is a clear no. It's just the starting line. It's not the finish line.
Ultimately, the entire conversation is shifting. The next great challenge isn't about technology anymore, it's about people. The focus is moving from just providing access to actively protecting users, building up financial literacy, and actually proving that these tools lead to real, measurable poverty reduction.
And that's our look at the very complex world of digital payments. Now, if you want to dig deeper into any of this, these are the primary sources the real experts use: the World Bank's Global Findex, the IMF's Financial Access Survey, the GSMA's big annual report on mobile money, and a ton of great research from CJAP. They are fantastic resources. Thanks for joining us.